Hey everybody, it must be Monday since we're doing another That's Our Two Satoshis live. Thanks to the pioneers who have been joining us thus far on this new show we're doing over here at Arca. I'm joined today by Sasha Fleyshman, one of the first ever employees at Arca, and he's been here for a long time. He is our portfolio manager. You might know him because of his expertise in NFTs and gaming, but he's actually probably been trading digital assets longer than anybody at Arca. How you doing today, Sasha?
I'm doing great. Just a wonderful day to be alive, Jeff.
That's great. Sasha goes by Arca Chemist on Twitter. Yet another part of his diverse background, chemistry major through school, and gave it all up to trade digital assets instead of poking around the periodic table. So we're happy he made that decision. He's been a welcome addition to this industry. So Sasha, here's what we're talking about today. Jump in as you see fit. But first of all, did you see how Bitcoin and gold shot up literally seconds after the CPI print last week?
Yeah, and if I didn't see it, you were right there to make sure I did. But yeah, I mean, it's whatever the flavor of the week is for Bitcoin. Risk on, risk off, risk sideways.
Yeah, well, I like it for a couple of reasons. First of all, I love that this market, the digital asset market in general, is becoming more efficient. It's not the old wild wild west like it was 3 and 4 years ago. Now you have enough traders and enough algorithmic trading bots out there that anytime you see real economic news or real news of any sort, you see an immediate reaction. Now that immediate reaction is not always right, and in this case, I think Bitcoin jumped up to what 69,000, and then it shot right back down over the next 24 hours. But it's nice to see that the market reaction is happening. So in my opinion, related to Bitcoin specifically, I got two thoughts. One related to inflation, one related to just market reactions in general. So we'll start with the latter. I think this was the most probably the most uh, expected result you could ever imagine for something like Bitcoin. Right, first is it jumps on on an inflation narrative, as if Bitcoin acting as a safe haven or as an inflation hedge, and therefore it should skyrocket as soon as you have a bad inflation print. But second, what happened immediately thereafter is we get to new all-time highs in Bitcoin. All the leveraged traders come in, and you're just followed by a huge leveraged liquidation that drives Bitcoin down. And it also went down because there was rumors that Evergrande over in China was about to default. So basically, within 24 hours, Bitcoin was a safe haven and an inflation hedge, as well as a levered risk asset at the same time. So do you think, my question to you, Sasha, do you think that we actually have a real narrative of what Bitcoin is yet on a short-term basis, or is it always going to be this flavor of the week that it just reacts completely differently to different pieces of news depending on how people want to interpret it that day?
Well, I just think that most of the people that talk about Bitcoin don't touch Bitcoin. It's probably the least touched asset within our space. I mean, you can see that in the transaction fees. You can see that anecdotally by speaking to people. I haven't touched Bitcoin personally in 8 to 12 months. Like, there's no reason to touch it unless if you're transferring value. So in 2017 and prior, the main facet for Bitcoin was as a dominant trading pair as a base currency. And now as it's moving away from that, the need for it on a day-to-day basis just shrinks. So there's a lot of soapbox discussions on what it's doing and how it responds, but in reality, it's just a very binary outcome and everything in between. So the people that are arguing that the store of value are right in the sense that we shouldn't really care about these day-to-day moves. The people that are arguing that it's a risk-on asset are also right because in the day-to-day moves, it is a risk-on asset. So I think it's just like a low time preference versus a high time preference type of argument.
Yeah, I agree with that. I think you know how I feel, which is that Bitcoin is a call option, right? It's either worth close to zero with a very low probability of that being true, or it's probably worth $1 million a coin with much higher probability. And every price move along the way is just investors telling you what that probability is increasing or decreasing along the way. I think there's no way for Bitcoin to move in real time relative to news like this and be consistent because as we talked about it, Bitcoin is a chameleon, right? It has a lot of different personalities, and it's going to over time mold into or morph into different things. So I like to see a market reaction. I like that the algos and the bots are looking for certain things. I like to say that you can say yes, Bitcoin is definitely something that will help in inflation, and therefore if you have a higher inflation print, you should see Bitcoin go higher. But I think entirely, as you said, entirely too much is read into day to day and week to week headlines for something like this that in our opinion is inevitably going higher at some point in the future. Okay, before we move on to Bitcoin, or before we move on, anything else to add on Bitcoin, or should we move on to what I think is more exciting?
Let's keep moving.
All right. OMG. If I'm not mistaken, you traded a lot of OMG back in what, 2017? Is that correct?
Yeah, that was back when the Bank of Thailand was partnering with McDonald's, and 2017 was pretty barren with actual news. So that was a good trading event.
Would you say that OMG has lived up to the expectations that you believed in back in 2017?
No comment.
Okay. Well, last week, what was interesting with OMG was, again, talking about market efficiency, right? So if you want to say that Bitcoin reacted appropriately and was efficient on the CPI print, what we saw last week with OMG was even more impressive. So OMG it was offering an airdrop of a new token called Boba. And if you owned the OMG tokens at a certain snapshot in time, you were entitled to get this Boba airdrop, which is a little bit different than how airdrops have typically occurred, right? Usually it's, they happen randomly, like, Uniswap or DYDX, and you don't know it's coming. Or it's, over the course of a couple months. This is the first, to my knowledge, of a set date or set snapshot in time where it says, if you are a holder of record at this snapshot in time, then you are going to be entitled to these Boba tokens. And as a result, it actually ends up looking a lot like a stock, right? A stock that goes ex-dividend means that if you're the holder of record at that time, or as of the record date, then you are going to get entitled to the dividend. And then ex-dividend, you're no longer getting it, so the stock will usually drop exactly in the amount of the dividend. This is the first time we saw something like that in digital assets, and it was actually really interesting to watch how OMG, the token, traded relative to the futures price, and the difference, of course, being that the futures is just a representation of OMG risk, but you don't actually own the underlying, and therefore you're not entitled to the airdrop. So, Sasha, tell me about how this thing traded and what you saw in real time with regard to the price of the token, the price of the futures market, and the funding rates.
Well, the only real corollary that you can pull from for something like this, where the futures market was utilized, was the Bitcoin Cash token split to BCHA and BCHN. The There was, I think, FTX created a secondary market for Bitcoin Cash N, which I think was the smaller favorable token, and that one traded pretty close. It was like 97% to 3%. This one was much different, where you had, I mean, the news definitely got out a little bit early. You could see the buy pressure coming in days ahead. I think it went from $10 to 14, 16, up in that range. And obviously, people that are just looking to harvest the boba yield were kind of trying to neutralize their risk by shorting the other side. And funding rate blew out. I think at one point it was 1.3% an hour. um
1.3% an hour. That's a big number.
Yeah, it's a
That's
matter of how much you think boba's worth. If it's the future of finance, then it's a small price to pay.
So it costs 31% per day or 11,000% per year to stay short the OMG perpetual futures while holding on to your OMG long. So yeah, that's high expectations for what Boba is going to be worth if you're going long the token and short the futures.
Well, I mean, I think the expectation was that as funding continued to get negative and expanded, there was almost a running joke online that it was Sam Trabucco versus the shorts, um, or versus the longs rather, because the longs were trying to push it higher, and you'd think with the negative funding there would be a squeeze, but in reality, the pressure is just such that if you could, it was almost ironic, if you could keep the shorts stuck and short, they're just forking over the funding, but the longs aren't making money either because they're collecting the funding while the perp is going down double digits. And it was kind of a situation where the only winner would have been someone who purchased OMG and then sold right before the snapshot and then just left.
Right. So basically, in anticipation of people buying the OMG token, you could have bought because of the airdrop. You just buy it and then you sell it before you even get the token, the airdrop, and you don't even worry about what the airdrop is worth. Yeah, I mean, I looked at and we put this in for those who read our write up on our blog at ar.ca/blog. If you look at it, we put a couple charts in there, but it was, like clockwork. Right before the ex-dividend date, so to speak, the token was trading at about $18, and the perp was trading closer to $13. And as soon as that snapshot was complete, the token fell like a rock right to where that perp was trading. So pretty efficient pricing. I think the probably the more interesting part is that nobody really knows what boba is worth or what it's going to be trading at. So it's not as easy, right? If this is the stock, right, and you have a stock trading at $10 and you're about to get a $2 dividend, well, then naturally, as soon as it goes ex-dividend, the stock should trade to $8, and you collect that $2, and the sum is still $10. But here we have no idea what that dividend is worth, right? We don't know where boba is going to price or where it's going to trade. So there's a lot of game theory and speculation that goes into putting on a trade like this. And clearly, if you were long the token and short the futures, you were hoping that the futures price was going to, probably hang out where it is, and the funding pressure would go away, and that the token, maybe moves back up to where the token price is. Not that the token itself will just crash down as fast as it did. So I'll be interesting if any of our listeners actually made money on this OMG trade. I'd love to hear it because it certainly was a setup that was interesting, but very difficult to make money off of. More importantly, I think from my standpoint as an investment manager, I think this is the future. I think you're going to see more and more companies and projects introduce rewards via staking, LPing, airdrops, and more. And what that means is these futures products, which are great for trading, are going to become less and less valuable versus the actual ownership of physical tokens, because you're going to have this proof of ownership to get all of these rewards that are coming. We've seen a few glimpses of it, like you mentioned, Bitcoin Cash, now OMG. I think Binance Coin about a year ago was the same thing, where if you actually physically owned the BNB token, you were entitled to some IDOs that they were doing on their platform. And obviously, if you didn't get it, if you were in the futures. But we haven't seen a lot of these scenarios. So I'm encouraged. I'm excited to see what happens in the future, to see if owning physical tokens starts to have a high premium versus the futures itself. So very cool. I love seeing stuff like that. All right. Lastly, before I let you go, Sasha, I have forced you to read things that I've written for the last 4 or 5 years, and one of the ones that I have been on this corner for longer than probably anyone is that every single company in the world will have a token on their capital structure at some point in the future. And I specifically used the example of Starbucks, that I've been a shareholder of Starbucks forever. I've never had a cup of coffee. I only use Starbucks to steal their Wi-Fi and to go to the bathroom. They get nothing out of me because I'm not a customer. I get nothing out of them, but I've been a shareholder. The alignment is totally misconstrued. Eventually, they need to have a token where everybody who's a quasi shareholder is also a customer, and vice versa. We heard last week from CEO Kevin Johnson of Starbucks that they are actually hinting at making this a reality, that they're talking about introducing a token in the near future. So what do you think this market is going to look like if corporates start issuing tokens that look like quasi membership, quasi equity? And if you continue to see city coins like Miami coin and New York City coin, and maybe eventually have schools and universities issuing tokens, how do you think this market will change, or what do you think the dynamic will look like when you start to have these real world tokens mixed in with the OMGs of the world?
Uh, I think that it's almost necessary. Uh, people like myself, I've never purposefully purchased any equities, any stocks of any kind, and I don't intend to do so. So not only are you alienating your customer base from your investor base, but you're also I think as the world is moving more digital, you're seeing less and less of the younger generations being involved in equities in general. So you're kind of just, stunting your addressable market for who will actually invest in your company. I think that the Starbucks use case is rather rudimentary, at least at face value. It's not like the token has the same type of rights as the equity. It's more of a rewards token for, you could make an EA Sports token, it'd be the same thing. But I think the path forward is that once they get their beak wet and they start to understand the kind of 0 to 100 intraday movement of grabbing new users through this mechanism, I think that this will start to become normal. The hard part that I'm looking at is, what does a world where we each own 500 different types of assets that are all tokenized, all in one wallet, there's going to have to be some UX UI build out, but I mean, this is how it's always been moving. I mean, COVID kind of sped it up, but it's been going like this since, since 2000, and probably since before then, but I was a little young at that time.
Yeah, unfortunately, I was an old guy then, and even older guy now. But no, I agree with you. I mean, I think the idea of just passive ownership of a stock is going away. It makes no sense to have all of your financial interests completely separate from the things that you do. Right, everything that you do on a daily basis or on a weekend, you should have some economic interest in, and that 100% aligns the incentives of all parties. So I agree with you. I think stock ownership, or at least passive stock ownership, is a dinosaur and is going to not necessarily be replaced, but certainly going to be complemented by having a token in the capital structure where customers choose to be a customer while also being economically rewarded for doing so. So I'm excited for that future. All right, Sasha, thanks for joining me. Again, for the listeners here, you can check out Sasha at Arca Chemist on Twitter. He's an expert in chemistry. He's an expert in Bitcoin mining. He's an expert in NFTs and gaming. He's a terrible fantasy football player, but all these things you can find him on Twitter. Thanks everybody for joining us, and we'll be back again next week.